Everybody asks me all the time. I'll go to a convention, I'll go to a seminar, I'll meet somebody on the street, I'll be introduced to some. In fact, I met somebody outside of a coffee shop. Somebody introduced me the other day, and the first thing he starts asking me, "What do you think I should buy Google or Alphabet? Or do you think I should buy Meta? Or what do you think's going to happen with?" I have no idea because I don't trade them. You know, but everybody asks, "Should I buy?" They'll ask me, "What will the prices be tomorrow?" I can't tell you how many people in the last 2 days have asked me, "How much is Bitcoin going to be tomorrow? Think Bitcoin's going to go up to 60? You think it's going to recover after 39?" I have no idea because I don't trade Bitcoin. I don't follow Bitcoin. But they all ask, what are the prices be tomorrow, next week, next year? Now, wouldn't investing be easy if we knew all the answers to these seemingly simple questions? At last, if you're attending this class in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you early. It doesn't. Nobody has a crystal ball. Nobody has a Ouija board. There's no system that does. However, if you're attending this class with the hopes that technical analysis will improve your investing strategy or your trading strategy, I have good news for you. It probably and hopefully will. Now, I'm going to give you one side mention here. I intermix the terms investing, investment, trading. Okay. We know when you're trading CFDs or short-term trades. Long-term investing is completely different, and investing, you actually are buying something to own or hold on to. Okay. But I intermix the terms, but you all know what we're talking about tonight. Now, the term technical analysis is a complicated sounding name for a very basic approach to trading or investing. Simply put, technical analysis is a study of prices with charts being the primary tool. Now, I take the term technical analysis and I throw it out the window. I don't use it in my everyday. Now, I trade from my charts only. I use certain attributes on my charts. But I don't call technical analysis sounds like this big scary science. But the fact is, it's really can be really called very easily chart analysis. It's anything and everything we do using a chart. Now, whether you're putting a oscillator on the bottom of your chart, whether you're putting a moving average over the price, whether you're using a candlestick chart, okay, anytime you're looking at a chart, you're using technical analysis. Now, the fact is, there are two different types or two different fields, actually three, but two primary different fields: fundamental and technical analysis. Now, fundamental analysis is all the other stuff. It's listening to news or headlines, social media. It's reading reports, looking at economic events. It's pulling apart, annual earnings and comments from, or sales by Walmart or sales by HSBC and overheads and the increase in shipping costs, all coming down to bottom lines, but it's all under the field of fundamental analysis. Technical analysis, like I said, is everything and anything you do on a chart. Now, the fact is, fundamental analysis could be your favorite way to trade, but fundamental analysis doesn't help you really figure out entry points, exit points. Is the price doing what it should be? Say you want to get you got some inside information. Say you found out from your brother-in-law this company is going to announce its earnings tomorrow and it's going to be much higher than the market expected. Now you go ask, what's the price of the stock? Call your broker. He says to you, it's $90. Well, $90 price. Does that tell you anything about the price? No. Do you know if it's been pushed up over the last few days? Because lots of people know this earnings report should be higher. Or where's the potential where it might go that you could buy it now and get out of it in a couple of days? What price should you actually buy it for? You don't get that from fundamental analysis. You only get that from charts. Now, most of the basics of technical analysis actually was developed in the 1900s by Charles Dow. We all know his name. from the Dow theory. We know his name from what? The very famous Dow Jones. He was the first one who started looking at markets through price and came up with the principles of trend, the nature of trends, price discounts, all known information, convergent confirmation and divergence, volume. He was the first person to actually start putting this together. But to be honest with you, he was a little bit all over the place. He would write this paper on that and this paper on, but he never actually was put the whole thing together in one ball. It took people after him actually put and took his theories and put them into a use space in the, now in those days there was only the stock market. Now the price of whether it's the euro, whether it's Bitcoin, whether it's Facebook, is a consensus. It's a public consensus. It's what one person's willing to buy an asset for, and what one person's willing to sell that asset for. Now, these simple statements are the cause of major challenge in forecasting prices because they refer to human expectation. And this is the one thing you always have to keep in mind. The market is made up of millions of human beings making human decisions. So no matter what you do with fundamental analysis, no matter what you do with technical analysis, it's only a guideline because all of those people out there are making human decisions, which puts the human element in there. Say for instance, there's a huge analyst or trader for some big investment house, and he trades billions of dollars a day, and he's a specialist on the euro. He comes in his office at the crack of dawn, and he spends his day buying and selling euros, you know, and makes a lot of money. He's very successful for the bank. But this morning, he had a fight with the wife. Then he got out of the car, ran out to the car, and he realized the tire was flat. He got the tire fixed and got on the highway, and now he was too late and he was stuck in the middle of rush hour. So he ended up getting to work late. He gets into work. He's in a bad mood. He's rushing. He's aggravated. He hasn't had his morning coffee when he arrived in. And the trade that he would have made if he sat down at his desk and turned on everything and he was watching closely, that first trade today that he would have made, he missed entirely because it's already happened. So that $1 billion he was going to dump in the market didn't get in the market. Well, that's the human element affecting it because everything said the euro should have gone up. And now he's one small person that can't affect the whole market. But that's just one small person over here. And we're just talking about a set of events that nobody's controlling. But imagine, just like when we had lockdown or the pandemic get announced, all these people, regardless of what the chart said, went into panic mode. So because humans are involved, I am sure that much of the world's investment decisions are based on irrelevant criteria. Now, if prices are based on investors' expectations, and then knowing what an asset should sell for becomes less important than knowing what other investors expect it to sell for. That's not to say that knowing what a security should sell for isn't important, but there is usually a strong consensus of an asset's price, whether it's based on future earnings, that an investor cannot disprove. Technical analysis is based almost entirely on the analysis of price and volume. The fields which define a security's price and volume I'm going to explain to you. But remember, we have in the field of technical analysis, almost every tool that we're using is based on very limited data that everybody has. We can base it on the open, the high, the low, and the close on the chart, and the volume. That's it. Okay. So what we do is we try to look at our price charts and have them tell us something. And what is these are telling us are sometimes referred to as price action. But the reason you need a chart is ultimately, if I told you an asset was trading at 131 this morning and went to 131.2, went down to 131.8, 138, and went back to 131.02, went to 132.04, went down to went to 134.05, went back to 132.02, and could you repeat any of that to me? Could you have made any sense out of what I just said? No. But if I put those same numbers on a chart, and you could look at them on a chart and look at them in a time progression on a chart, you could then take this information and put it into visual representation. So what is a chart? A visual representation of price movement. So technical analysis involves looking at price patterns and price based on history to determine the higher probability and the place to enter and exit a trade. As a result, technical analysis is one of the most widely used types of analysis. Since online trading is, in most cases, involves only major assets, the movement on a chart from the price action generally gives us clues about hidden levels of supply and demand. So again, technical analysis is a bit of a misnomer since it is really not that technical. A better name for the use of charts for investments and decisions that might affect risk reward analysis would be chart analysis. So simply stated, technical analysis is the study of data generated from the markets and from the price action or actions of people in the market. Such data includes price levels that have served as turning points in the past, the amount of contract shares being bought and sold each day, or known as volume, and the rate of change of the price movement or momentum over a given time span. Well, what they do better than most is decide what to do: buy, sell, or hold, at what price to enter the markets, at what price to exit the markets. Now, let me pop up some live charts on our screen for us here for a sec. Now, this is a standard price chart. This is the Bitcoin US dollar chart. Not for any other reason that I just had this chart up for something else. But on this chart, you see several lines crossing over each other. Those are moving averages, which are the simplistic, most simple way of technical analysis. But when we look at a price chart, actually, let's get rid of all this. Let's take a look here at the Euro US dollar. Basically, simple chart. Let's change the most basic of charts. This is called a line chart. A line chart doesn't tell us anything about price. Okay, you can't decipher from it. It gives you very little information, but you can see something in there. After that, we come to a bar chart or a candlestick chart. Bar charts were the most popular when I started trading. Today, it's candlestick prices. Now, each candlestick on a chart gives us a piece of information. Each candlestick gives us the open, the high, the low, and the close of that particular time period. But by being able to read the price and being able to try to read what price action is trying to tell us, we can start interpreting the markets. So technical analysis is the study of charts and what price is trying to tell us on those charts. Now, we can use things like very simple moving averages. We can get up to more advanced technical analysis by combining our charts with chart patterns and other types of indicators, like here we have MACD and we have RSI below. And together we build a trading system. But whether you're using one of them, two of them, all of them, none of them, simply using a chart is the beginnings of technical analysis. And ultimately, no matter what system you're using, okay, you need to be able to figure out which way the price is moving, what the entry point for be for your price, your asset, if you're going to trade up or down, long or short, what the target point would be for that trade, and where you would have to put your stop loss to protect yourself, because we're always calculating risk reward ratios to manage our risk management. We have to know where the next point on the chart would be where we would reach congestion, where how far we think that trade would go, that and what price we sell. And then we need to be able to monitor that movement to see if the price is doing what we said or thought it should do, so we can either stay in the market or remove ourselves from the market. You can only do this using technical analysis and price action interpretation. Now, we can use basics like moving average, and then those moving averages can be combined into multiple different time frame moving averages. And we have moving average crossovers, we have MACD, we have lots of different systems. Okay. How we apply these technical tools are completely up to the user. Okay. You can be like me. I trade from chart patterns and support and resistance, and from some basic candlestick responses at important points. That's all I use. Other people combine several different oscillators and indicators, and overlapping the different oscillators and indicators. Others, like on this chart, is we have our support and resistance levels. We have already predetermined our entry points when price reach. But remember, no matter what we did back there, it doesn't help us. We can only trade moving forward. But looking at the history of price and where it's going, where it's been, can help us understand what to expect in the markets moving forward. And then we have more advanced things like Fibonacci levels, okay, and Fibonacci calculators that will help us come up with our support and resistance levels. Okay, we have all types of different trading systems that we can use. How you combine them together to build your trading strategy is very personal. Now, my advice to anybody is never get overly complicated and never use more than a couple. I've seen some trading systems, actually, I'll pop one up. I think I have some that are so complicated that I don't know how anybody figures out anything. Hold on a second. Let me pop one up here for you. See, this is another nice clean one. Looking for chart patterns, volume, and support and resistance. But now look at this. There's so many lines in this chart. Oh, this was sent to me by a student. I couldn't even figure out what they were looking at and how they'd make a decision. But I can't tell somebody not to use their own system. It's just like a roadmap. When you start looking at when I was just starting out, I had a business partner, and we would have to travel all over the place to meet with investors and clients. You know, in the 1970s, we had virtually no computers. You know, computers covered a great big room with air conditioning and did very little, you know, outside of data processing. We didn't have GPS. We didn't have mobile phones. Now, my business partner could read a map, and that's what we traveled from when we go to meetings, from a map, an atlas. Now, I would get lost, and I would look at an atlas or a map, and I would see this. I would just see a mess. Peter could look at this atlas, and he would automatically, no, we're going to get on the 405 at this exit, get off on that exit. You want to stay in the right lane to go up there, and we're going to go down to the first left turn when we pass the church, turn right at the church. We're going to go past the church, and when we get to the filling station, we're going to turn left. Never got lost. He could read it like the back of his hand. And all those maps had these little narrow lines and wide lines and colored little pinpoints. But he knew exactly what they meant. He could decipher and get us where we're going. Well, a chart is the same thing. It's your map to where price is going in the future. Now, if you don't overcomplicate it, but you can read what that map is trying to tell you, you're not going to get lost. Now, again, remember, all of this is technical analysis. So the foundation for technical analysis is the chart. And in this case, a picture is truly worth 1,000 words. Okay, I'm just trying to, I spoke so much while we were looking at the charts. I'm just trying to get us to the point where we haven't covered. Technical analysis is a study of historical price action in order to identify patterns and determine probabilities of future movements in the market through the use of technical studies, indicators, and other tools. Technical analysis boils down to two things: identifying a trend, and identifying support and resistance levels through the use of price charts and multiple time frames. Because markets can only do three things: they can move up, they can move down, and they can move sideways. Price typically moves in zigzag fashion. Most price, because there's so many human beings involved making decisions, the price is a mess. Okay, when you see these beautiful charts and these beautiful creatives that I use or anybody else has used, or you see a chart with all of this stuff set up, okay, if you look at it, most of the time, price is a mess. Price moves mostly sideways. It doesn't move in what we call a well-developed trend. Now, price could be moving up, but a trend is the movement of price. Now, price could move like that. Okay? We don't have a trend. It's moving up. Good investment. It went up. You sold it, made profit. But the quality of the trend is what we see on price. The more well-developed the trend, the more reliable your information will be. Now, because there's literally hundreds and hundreds of assets with hundreds and hundreds of trades you can make, finding well-developed trends are easy. And remember, the quality of your trade is enhanced by whether if you believe the old adage, always trade with the trend, or you want to be a counter trend trader, that's fine. But when price is making higher highs and then higher lows and higher highs and higher lows, okay, we can decipher what's happening. Now, the fact is, okay, most of the time, it isn't. It's zigzagging, it's in congestion, it's sideways ranging. But remember, when price starts moving in a well-defined trend on a chart, okay, and you can start making some analysis, that price movement, and believe me, no matter how many traders you talk to, no matter how many professionals you talk to, they're all going to tell you the same thing, or a healthy percentage of them, that once prices started moving in a direction, if price starts trending up, it's going to continue that way. Now, where it's going to stop and turn around is a different story, but it takes a lot of momentum to get price to move up. Imagine a hamster in a cage turning that wheel. Remember when we were kids, you had that hamster in a cage and he would run around in that wheel, and you'd be amazed by how long he could run. But getting that wheel started, it was a very difficult process. And he'd get start slower and slower and then faster and faster and faster. Okay. Well, that's what price is now. To slow down takes a lot of work. So once we get enough traders in the market that are pushing a price up, it is most likely going to continue in that direction until some point it's going to reverse. But when you can find that trend and it's starting and continuing, it's a better bet to stay with that trend. Trying to pick the point where price is reversing is what we call trying to catch a falling knife. You'll see the momentum shift in a trend on your chart. If price is moving up steadily and all of a sudden it starts losing that momentum, we have indicators that can show us the speed of the movement and the momentum, and we can see that shift in momentum on a price chart. Now, technical analysis is based on the theory that the markets are chaotic. No one knows for sure what will happen next. But at the same time, price action is not completely random. In other words, mathematical chaos theory proves that within a state of chaos, there are identifiable patterns that tend to repeat. Now, I am this firm belief that most of the time the markets are totally random, but there are periods of time the markets exhibit non-random behavior. And these are periods are also known as trends. When the market is exhibiting this non-random behavior, we can then make intelligent trading decisions. So this type of chaotic behavior is observed in nature in the form of weather forecasts. For example, most traders will admit that there are no certainties when it comes to predicting the exact price movements. As a result, successful trading is not about being right or wrong. It's about determining probabilities and taking trades when the odds are in your favor and minimizing your risk. Part of determining probabilities involves forecasting market direction and when or where to enter the position. But equally important is to determine your risk reward ratio. Remember, there is no magical combination of technical indicators that will unlock some of the top secret strategies. The secret of successful trading is good risk management discipline and the ability to control your emotions. Anyone can guess right and win occasionally, but without risk management, it is virtually impossible to remain profitable over time. And this is one of the most important parts of technical analysis. It helps us to determine our risk reward and our risk management. It helps us determine where we need to put our stop loss. It helps us let us know whether the market's moving in the way we expect it to move. It helps us let us see that the shift in momentum or shift in direction. It helps us with our risk management and exiting the market. Now, since chart watching is not infallible, an even more important aspect is that it tells us quickly if our assessment of the market move is incorrect. For example, if prices move higher from a triangle trading pattern chart and then fall back within that pattern, we know that we were incorrect in our original decision to buy, and we want to get out of the market. Either we missed something on the chart or the market simply changed its mind. We can consider to sell immediately or book our small loss, leaving our egos at the door. And that's the whole thing, is when the market moves against you, that you get out of the market with the smallest loss possible, because nobody trades 100% right. Nobody trades, 50% right or 70% right. I'm very lucky if I can do 62 to 65% right. But as long as my successful trades make a good deal more than my unsuccessful trades, I have a net profit. And that's all that I care about. So if you're constantly looking at minimizing your loss, minimizing your risk at all times, and again, this is what technical analysis is great for, letting us know if the market's moving in our favor, if it's moving against it, if it's doing what we thought it would do, if the momentum's going our way and the speed is going our way. So while professional technical analysts have dozens, if not hundreds of tools at their disposal, it all boils down to 3 steps. Seeing where the security is currently trading, figuring out how it got there, determining the power of the trend, and making comparisons to the assets, its peers in the industry, even to its own history. To do all this, all that is needed are these key technical tools: trends and trend lines, support and resistance levels, and then some key technical tools like moving averages or MACD, or something that's going to give us a volume and speed. Okay. Using complex advanced indicators overlapping with several indicators, using MACD and RSI and stochastics all on your charts just becomes redundant. So relative performance. These are simple ratios of performance to a relevant market index or group. So if you're trading stocks or you're trading commodities, if you're trading gold, you want to be watching the dollar. You want to be watching silver and platinum at the same time. You want to be watching copper. You want to be watching assets that have relative performance or opposite performance. So now that we have a theory and the tools, let's look at the process going from an idea to an actual decision to buy. And that's setting your steps. So when we look at the trend, we want to see whether it's a rising one or one that just started to rise. Finding nearby support and resistance levels on our charts. If the asset passes all these tests, we have a candidate, not a trade. We have a candidate trade. Maybe now it's time to apply some risk management and some experience, because all of these things can only give you tools to make your decision. Then we can use these tools, and especially our charts and these other tools, to calculate our risk reward ratio, to calculate our risk management, to determine our entry points, and then your experience will help you make the right trade. Figure out how much of a trade you're going to make, how much money you're going to invest, what your leverage is. That's not on these charts. That's out of your own personal character. That's out of your trading plan. That's when you sit down and you've decided what your rules of a trade are. So this is just the beginnings of using your charts or technical analysis to help you improve your trading. But please don't get wrapped up when 22 gurus tell you when MACD does this and you have a divergence here and you have that, you'll go buy. Okay, it doesn't. Price action on your charts in conjunction with some indicators and oscillators and your understanding of the market is what will help you make the good decision. Then those oscillators and indicators will help you to see that the market's not doing what you expected to get out or stay in. And you can use certain indicators to calculate your stop loss points and your target points. But it's all about managing your risk and making smart decisions that you understand. So thank you very much for joining us tonight. And when you want to learn all about indicators, also we have a zillion courses. Every week we have a different class. And some weeks we spend an hour just discussing MACD. Some weeks we'll have an hour of discussing just moving averages, because in 1 hour I cannot explain to you all the different indicators, and there's 5 groups of different indicators and oscillators. I can't even spend in just 1 hour. I can just explain triangles in 1 hour. It takes me 1 hour to teach you support and resistance. Okay. So now you have a good grip on where you want to get started. Because believe me, it's not very complicated. So thank you very much for joining us tonight. If you have any questions, just type them into the screen or go to www.alvexo.com and send a chat message, and somebody will be glad to answer. If you write them into the screen here, somebody will get in touch with you tomorrow and answer any of your questions. So write them all out. They're automatically registered in the class. And believe me, everybody will put them together. So have a wonderful night and talk to you again real soon. Bye now.